Hello everyone, welcome back to another installment of our Lunch and Learn webinar series. I'm your host, Mayur Thaker. I am an analyst and the co-portfolio manager of the Zacks Earnings Certain family of portfolios. And today we're just talking about inflation, as we've been hearing in the news media for the last several weeks and months. In fact, over the past year and a half, that's been the main topic of interest for most people. And here I have, created a couple of slides, and this is a continuation of some of the themes and concepts that we've been talking about in prior videos. But I wanted to kind of put it all together and basically make the case that inflation has likely peaked. So that's the what, but then the why behind it is a little bit more nuanced. So let's get, going with exactly why I think inflation has peaked. So let's take a look at a couple of these different charts that we have been showing here. The ISM backlog index, this is a subset of the ISM manufacturing index. This continues to telegraph a substantial drop in the CPI. It took a little bit longer than I thought. I've been kind of saying this really for the last 6 months or so. So I've been wrong on timing. But I think that, as long as this backlog continues to drop, the CPI won't be too far behind on that curve. So we've seen backlog, ease substantially, for the past year and a half. And only now is inflation finally starting to ease off from that high watermark on a year-over-year basis. We hit, 9.1% at the high end earlier this year. That was, basically nosebleed level inflation. But now the index is still increasing year over year, but at a much lower rate of change. And now for the first time, really this entire cycle, we see the backlog is now firmly in contraction, because any reading below 50 indicates contraction in the backlog overall. So I would not be surprised. I know I've been saying this all year. So again, I do apologize. I've been wrong on the timing of this. But I believe that, this trend in backlog cannot be ignored. And ultimately, inflation will follow the backlog. And it makes intuitive sense, right? Because backlog increases when demand outpaces supply. And backlog eases when supply outpaces demand. So now that the backlog is down significantly and now basically in contraction mode, I would not be surprised at all to see the CPI follow suit here. So I do expect the CPI to drop off quite substantially, and it might actually get pretty quick too on the downside in terms of the year-over-year growth for the CPI headline index here. The ISM manufacturing prices paid also shows similar dynamics, and now we're actually below 50 on that one as well. So this is the prices that manufacturers actually pay, for their input costs. And this, again, is a direct reflection of inflation. So because these are the actual prices that they pay. So that, is directly basically the definition of inflation. So we saw this number hit basically nosebleed levels, earlier this year. And especially back in the summer of 2021. This number has come down quite substantially, and I believe that that's going to continue further as well. So the combination of these two, I think, indicate quite clearly that, the CPI number will come down. So the evidence overall is building. If you look underneath the hood exactly as to why that's been happening, the key reason for falling prices, in my view, is easing demand. And we can see this through a couple of different indicators, such as the new orders index. This is another subcomponent of the ISM manufacturing index. And we can see here that for the first time, it did drop below 50. It did rebound in the most recent month for, in terms of the reading in October, but it's still below 50, which means contraction. So new orders coming in have clearly slowed and are actually in decline now for the second straight month. So the longer we remain below 50, the longer we are in contraction mode in terms of new orders. So this is a direct reflection of falling demand. As new orders ease, inventories get cleared and backlog comes down. And that's why we're seeing kind of a direct relationship between the new orders index and the ISM backlog index. And then if we look at some of the press releases directly from the ISM, right, and this is taken from the Chicago PMI, and you can see that weak economic outlooks are dragging on demand. You can see that right here directly from their press release. And you can see from over here, this is directly from the ISM manufacturing press release. In the meantime, demand eased with new orders index remaining in contraction territory. So you can see again that there is anecdotal evidence that demand is easing. Here you can see, one of the other sort of reasons why I think inflation is coming down, and that is because the Fed is very clearly removing liquidity, and you can measure liquidity by the M2 money stock. So the M2 money stock is one of the measures of the money supply that the Fed is directly in charge of managing. And you can see if you just look at the green line, this is the absolute value of M2, the green line right here. So that references the left-hand y-axis. You can see very, very consistent growth. I mean, it really doesn't get affected much by recessions or by bull markets. It's got a very smooth growth curve. This is to support long-term growth of the U.S. economy, right? As the U.S. economy expands, the demand for money expands, and so therefore M2 has been a very, very stable growth curve year over year until we hit 2020, where the gloves came off and we saw the greatest expansion in the money supply basically in the history of our country. In terms of the deviation from long-term trend. That's been incredible. But now look what's happening. You can see that the growth rate, which is indicated in the orange line, this is the year-over-year growth rate, historically speaking, and it's always kind of fluctuated between at the low end about 3% and at the high end about 10%, historically speaking, on a year-over-year basis. And we're now at 2.1%, and that's actually set to fall below zero for the first time in over 60 years. If you zoom in on this, you can actually see that we are now at a M2, monetary base that is below where we were last December. So if we get one more month of a declining M2, then this number is going to fall below zero, and that has never happened really in the last 60 years. You'd have to go way back to the 1950s, I believe, when the last time we had a year-over-year decline. I believe actually it was back in the 40s, so it could be almost 80 years now. The data goes back so far that we don't even have data, that far back. But this is basically what this is indicating right now is a decline in liquidity, and the Fed has been telling us this all year long that they intend to taper the balance sheet, which is also impacting the M2 money stock. So again, this supports the thesis that prices are going much lower than where they are right now. Also, we can see, again, this is a little bit more anecdotal evidence, but you can see this is actually was published just last week on CNBC that the global shipping industry is facing a new problem: too many containers. If you remember, the big headlines for the past year and a half were soaring shipping prices. From Shanghai to LA, the cost of shipping a 40-foot container, went from about $2,000 before COVID to about $18,000, during the height of the inflation. And that number has now basically round-tripped all the way back down to where it was before COVID now. And now we're actually starting to see some reports that say that many ships now are being sent half full from Shanghai to LA. So there is clearly a quite substantial drop in demand for shipping. And that is a direct reflection of, overall demand for industrial products as well as retail products. So again, I think this is another indication that the reason for why prices are coming down is the wrong reason. Remember, there's two ways that inflation can come down. One is a very good way and one is a bad way, right? The good way is that, labor returns to the workforce. There's plenty of people working, lots of work getting done, productivity is rising, and therefore production is increasing. And therefore production catching up to demand can also put a lid on inflation. That would be a great way to bring prices down. And that would be very healthy for the economy. However, the bad way of bringing prices down is demand destruction. And unfortunately, that's, I think, what we're seeing here is that the primary driver for lower prices is an easing backlog. And the easing backlog is due to demand evaporating rather than supply catching up. Also, the other thing too that could be affecting demand is the wealth effect, right? On the way up, when everyone's homes were being appraised for higher and higher, and when everyone's 401ks and IRAs and personal brokerage accounts were hitting all-time new highs, that wealth effect can be a big driver of demand. And so, as stocks rise and real estate prices rise, that creates this illusion of wealth that actually keeps revenue and earnings artificially inflated for a lot of companies throughout the entire economy. But once, stock prices come down and real estate prices come down, suddenly people feel a lot less wealthy than they were before, and that changes spending behavior. And that is another reason for why I think there is downward pressure on demand. This is also compounded by the fact that we have soaring interest rates coming from the Fed, which is also driving mortgage rates much, much higher. We know that mortgage rates have hit highs that we haven't seen in more than 15 years now. That's putting a big cooling effect on residential real estate. And that's why we see Zillow and Redfin both reporting record numbers of cuts to list prices, for homes that are for sale. So, housing had a massive boom, well above the long-term trend growth in real estate prices. And now I think that there is reason to believe that there will be mean reversion happening. So prices should be coming down a lot more than they already have. So that is going to put, a damper on demand for quite a while. So, you can also see the Chicago PMI is telegraphing a pretty big drop in earnings growth for the S&P 500. Remember, Chicago PMI is a great blend of both supply and demand, actually, because this is actually looking at the Rust Belt and manufacturing activity in the Rust Belt. And this includes both new orders as well as production. And the Chicago PMI has basically fallen off a cliff here. You can see that, this epic decline from the peak here in mid-2021, and now it's firmly in contraction. This is actually a recessionary call right here. And you can see historically that earnings growth, which is indicated in the green dotted line, have had a very, very strong positive correlation with the Chicago PMI, which makes sense, right? The stronger the manufacturing activity of the Midwest United States, the more bullish that is for S&P earnings and vice versa. And now that we have the Chicago PMI firmly in contraction mode, I think it would not, surprise me if we saw fiscal year 2023 earnings per share be lower than what earnings were for fiscal year 2022. And that is currently a call, that is not consensus. The analyst community is currently not expecting that to happen, but I would not be surprised if that did happen. And earnings are already being revised down towards, where I am at personally. So you can see this is the earnings estimate revision for the market overall, with and without energy. So you can see on the left-hand side, for Q4, just about, by the end of August, the expectations by analysts were for about 2.5% growth year over year for Q4 2022. That has since been revised down to about 4.2% to the downside. So now analysts are actually expecting contraction in Q4 versus Q4 of last year. And that's including energy. If you remove energy, that's the one sort of bright spot in the market right now, thanks to elevated oil prices. But if you remove oil stocks from the equation, S&P companies are now expected to decline in earnings by 8.7% year over year in Q4 this year. So earnings are being slashed at an accelerating pace. And I think that number is just starting here because we've still got quite a ways to go before full year 2023 earnings forecasts are below where they are in 2022. You can also see overall for next year, this is, the aggregate S&P 500 X oil and energy stocks. This hit a high watermark in, April at, 2032. Don't worry about the numbers here. This won't line up. This is not going to line up with the numbers that you see quoted in financial media, just because this is a slightly different way that we do it from a top-down basis. But what's more important is the revision in this number. And that's kind of what I'm trying to sort of illustrate here, that, earnings have been revised down quite substantially. And I think that there's a lot more to go, given where we are with just the starting point with where, how low housing prices can go, and how low the Chicago PMI currently is, as well as other leading indicators of the economy. So, analysts are still not forecasting fiscal year 2023 earnings to be lower than this year, but I think that's where this number is ultimately going to end up as we, get Q4 numbers in late January. So, how do investors deal with this? So, in a market environment of uncertainty, we should invest in companies experiencing secular tailwinds, who make critical products and services and have a proven record of consistent earnings per share growth on attractive ROIC even through recessions. So in other words, invest in the earnings certain portfolio. And that's what this is here. So, with endless amounts of uncertainty, why wouldn't you want to own a portfolio that had earnings that look like this, right? And so we've been through recessions. We've been through, various different macro shocks, like Brexit in 2015, like a strong dollar right now, like a weak dollar, just 5 or 6 years ago. A very varying volatility with commodities prices. We've been through a number of different cycles over the past 25 years, and you can see that this portfolio of companies have, consistently executed through all of it. And that's the type of certainty that I believe is going to outperform. So the earnings certain portfolio has greater earnings stability and faster cumulative earnings growth versus the S&P 500. So you can easily remove the volatility of the S&P simply by owning utilities, for example. So some people might say, well, so what? I can just own utilities and call it a day. Well, utilities don't outpace the earnings. Utilities don't grow faster than the S&P 500, in terms of earnings per share growth. So yeah, that will provide, protection during recessions, but what about exiting recessions? And what about over a complete market cycle? And here you can see that the earnings certain portfolio not only provides certainty, like utilities, but it also provides faster earnings growth because these companies are long-term compounders. They're companies that continuously reinvest cash flows back into themselves to grow. Utilities don't reinvest back into themselves because they don't have as much growth opportunity. They are regional, players that, once they've set up shop, there are no reinvestment opportunities with a couple of very few exceptions. Utilities are not compounders. Utilities are cash cows. They provide certainty. They do provide recurring revenue, recurring earnings, but they don't grow very quickly. Whereas the earnings certain portfolio are companies that have the capability and have the management and have fundamental businesses that are recession resistant and whose managements, can continuously reinvest, cash flows back into themselves to grow. So these are companies that earn high returns on the capital that they reinvest, and that's what leads to faster growth. And their businesses fundamentally are recession resistant. And that's why you don't see these companies get hit, very much at all during recessions, like what happened in 2008, like what happened in 2001, and like what also happened in 2020. So, the question is why do you want to own companies like this? These are companies that you would own if you own the S&P 500 index. Why do you want to own this mess? right? This is just so much volatility, very little returns, requires timing, requires macro analysis. Why deal with it all? Why deal with this type of just noise, right? When you can own companies like this. These are secular compounders, companies that continuously reinvest cash flows back into themselves to grow. And companies whose businesses are basically unaffected by the business cycle. That's exactly the type of companies that we own in the Earnings Certain portfolio. So again, to recap, we want to find companies that have high long-term earnings visibility. We want companies that earn high returns on invested capital. And therefore, the combination of these two gives us faster cumulative earnings growth. Low beta by design, by kind of not design, but just by consequence, you end up with companies that are pretty low beta. And they have large outperformance during bear markets and only just slight underperformance during bull markets. That's the other amazing thing about the Earnings Certain portfolio. So that gives us better cumulative and risk-adjusted performance over a complete market cycle. And you can see that, as of, the latest reading through, October of this year, October 31st of 2022, the performance of the Earnings Certain portfolio is, minus 11.1% versus 17.7% down for the same period for the S&P 500. So it's designed to do exactly what it's doing exactly what it's designed to do. And these are just a few of the iconic companies that we own in the portfolio that are basically just some of the most remarkable businesses in the world who, have proven track records of growing even through recessions. These are companies that are embedded in their industries respectively, and make things that are critical needs rather than supplying nice to haves and wants. And that's why we own them, and that's where we deliver alpha over the long run. So hopefully you found this helpful. Would love to hear from you if you have any questions or any feedback. You can reach out to me if you are a ZRS client. You can reach at zrs@zacks.com. And if you are an Advisor Tools client, please do send us an email at zat@zacks.com. And if you'd like these slides as well, again, I'd be happy to send that over. So just please email us and I will send you a copy of these slides. All right, everyone, thank you and hope to see you again soon.